Pleased today on the Insurtech Leadership Podcast to be here with Adam Price. He is the CEO of Kinetic, a monoline workers' comp MGU, providing technology-centric tools to insureds to help lower premiums and improve workplace safety. Welcome, Adam.
Yeah, thanks so much for having me, Josh.
Absolutely. Well, that's a bit of a mouthful there. So maybe
I was going to say you nailed it. You know, you could be the CEO with that line.
Right. So for those who probably know the segment, I'm sure that all makes sense. But maybe for the broader audience, you could give us just a quick 30 seconds on your elevator pitch or your quick thumbnail of Kinetic.
Yeah, I mean, it's pretty similar. We sit between capacity providers, which are traditional insurers, and retail brokers, and we provide value-added services on workers' comp policies in the U.S. We specifically target higher premium policies because a lot of our tools for technology around prediction, prevention, and management really come into value when you have claims and have a higher premium that you're really trying to control and not just looking for kind of a lower cost option. And we work with these capacity providers. Nationwide Mutual is our largest by far, and work with these retail brokers to bring something new to the market for their policyholders and really use technology in a way that hasn't been done in workers' comp in the past.
So does that mean that you focus on industry segments that, generally speaking, have higher or more severe claims, or helping companies that are sort of above typical averages in amount of claims or level of claims that they have?
You know, we don't necessarily focus on pure high severity. We can get into it, but a lot of the technologies out there just aren't that great at helping manage or prevent severity style claims. What we really focus on are high frequency, lower severity industries, and where the premiums and payroll sizes can be at thresholds that warrant $150,000 or $200,000 or higher premium on an annual basis. At those levels, it's a big enough ticket for the business owner to really be concerned about the premium and controlling that premium over time. And that's where we find the best resonance for our types of service-centric approach in the market, but not necessarily higher severity.
Got it. Okay. And so how did sort of the business come to be? What was the origin of the company?
Yeah, it's a really interesting story. So Kinetic was started almost 12 years ago now. And it was started by two engineers, Haitham and Aditya, out of New York City. And they had a focus of how could you use technology to prevent injuries in the frontline workforce. And they really focused on what is really the most common and costly type of injury, which in the workers' comp lingo world is a strain and sprain injury, but in normal speak is typically a lower back injury or something of that nature, from all the kind of improper lifting, twisting, moving that you see in those environments. So about 10 years ago, they developed a wearable device. In fact, I've got one here on my desk that I can hold up, and it's about the size of a pager, and it clips into your waistband and has a bunch of sensors on it that help track how your body is moving throughout the day, and provides two functions. It provides real-time feedback. So when it sees one of these improper movements, it vibrates for the user and kind of acts as an always-on safety coach, especially in these remote environments where somebody's not being watched by a supervisor directly.
Right.
And it collects all that data over time, so you can see how these postures, what we call high-risk postures, are improving. And so for the first 6 years of the business, we really focus on just leasing these devices to very large self-insured. So think UPS, Home Depot, Amazon, those types of organizations. And what we found was that the device worked really well, but in essence, there wasn't a huge market of these self-insureds that were ready to go out and buy $10 million worth of devices on an annual basis. It's very few and far between how many companies are out there. So we had this product that worked really well, was very unique. But we just didn't see a very strong go-to-market, eventual go-to-market and making a big business there. And I joined Kinetic in 2020, and my background is coming from much larger organizations where we are a buyer of workers' comp. And so I started talking with the co-founders at that time saying, look, we have this product, it's super effective, but this go-to-market strategy just isn't really panning out to the business size that we want over time. And so, what do we think about potentially rolling the product into a workers' compensation policy? Because at the end of the day, that's what our product was helping. With self-insured, it was a little bit different, but a little bit smaller than self-insured. There was a lot of appeal to have something unique in the market. And so we, as a group, we started looking into that. And during 2021, we learned about insurance and how to set up, an insurance entity. And we ended up choosing this path of an MGU, where we sit as a middleman between the carrier and the brokers with this value-added product. And it's gone really well since then. We've grown the business from basically no premium is the metric. We're almost at 90 million of premium 3.5 years later. And I'd say the other big change in our go-to-market has been, we started with this single product. We had this wearable device that I showed you, and it was, Kinetic was kind of the workers' comp market, but with a wearable. And we saw within 6 months of writing insurance that there were a lot of policies and a lot of injuries that the wearable wasn't going to do anything to help. And so we, about 3 years ago, started expanding how we used our technology resources, because we had a lot of software developers and product managers here. And we started really focusing on what can we do to holistically affect workers' compensation outcomes. And we ended up dividing that into 3 categories. You can predict the risk better by taking in a lot of data and really trying to assess the correct premium price for the risk. You can use a tool like wearables to help prevent common injuries in those categories that we focus on. And I'd say our primary focus for the last several years has been, you can manage the claims better. Regardless of type of claim, there's a huge opportunity to use software to manage claims better. And so that's been kind of our go-to-market shift since kind of the beginning of the business, with just wearables leased to the large self-insured, the transition to an MGA with wearables, and then really quickly after that, a transition to an MGA that really thinks about a product suite of technologies to help workers' comp.
And so are you managing those claims, or are you working with third parties to manage those claims?
So in our biggest capacity relationship, which is Nationwide Mutual, they manage the claims. But what we do is we have software that integrates into their Guidewire Claim Center and pulls down their data on a daily basis around all the pricing and adjuster notes relative to the claim. And then we identify next best actions through that information. And then we help almost complement or drive horsepower into the system of managing the claim and working with the policyholder, the adjuster, for better outcomes.
Got it. So is this a solution that you're strictly going to keep in-house for your own clients through this MGU, or is it something that might be its own standalone product?
Yeah, it's a really good question. I think for now, what I've seen, even if we had the goals or aspirations of using our platform as a standalone product and providing that to insurers, insurance is a slow adoption industry. And there's a lot of value to what traditionally called in software eating your own dog food, basically showing that your product works. So the MGU offers us a really nice avenue to develop quickly, use the product ourselves, really build the foundation. And down the road, I think we might consider, the extrapolation of that platform to, people that aren't written by us. But for now, that is our value differentiation. There's 100 markets that'll write workers' comp for you out there. And a lot of brokers will just tell you comp is comp. It's the same coverage, so you should just buy it based on price. But at the premium levels, we focus on, and the risk managers we really want to partner with, service is a key component of how these buyers are evaluating the product. And so by having this platform to really manage the claims, which is a huge pain point in workers' comp, we think that service differentiation really warrants the MGU, and it is the reason we're growing, at such a nice clip.
And so what has the distribution strategy been to, sort of get past the folks who say comp is comp to, the partners or the distribution channels where they see the value you bring to the table?
Well, I'd say first and foremost, it's setting our premium floors. If you're down below, we write down to 50,000, but I'd say our sweet spot is really 200K and north. And you want to be at premium thresholds where the customer has had issues and is at a payroll size where claims have come up and they've seen the impacts of service. So that's first and foremost is you've got to set premium thresholds to really identify and get to that customer base. The second is we use a very limited broker appointment strategy. So we truly partner with a broker that wants to be a risk consultant, not a quoting shop. And that's incredibly important for us. So that tends to be, much more established retail brokers with very large books. We don't have a list of 5,000 brokers with $1 million book that we're going out and trying to educate and partner with. We're looking for brokerage and agencies that have, 100 million or higher and in these premium thresholds. So they've gone through the motion already for the last 20 or 30 years of being a true risk consultant and knowing how to sell these services and value.
Got it. And so obviously the decision to become an MGU was a huge inflection point for the company. Are there any other major inflection points or major decision points that you've had to focus on either since you've been with the company or since you've been in the CEO seat?
I'd say, the decision to become the MGU was a big one. And to be honest, this was back in 2020 when there were some high-flying Insurtech MGUs that, we looked around and said, hey, this looks pretty appealing. Now, a lot of that has died off. And luckily, we probably stepped into it for the right reasons.
Yeah.
But the biggest by far after that was the focus on products outside the device. We could have very narrowly stayed, focused on a single point solution in prevention and, push that, till we were blue in the face. I think, we made a very good decision 3 years ago when we decided, look, you can't just have a point. There's no silver bullet. You can't just have a point solution. The true application of any point solution, especially around prevention, is just limited to a pretty small niche of business, even if you're focused inside a specific industry that has a lot of exposures for that point solution. And so the move to focus on, we do a lot of R&D on modeling and can underwrite in our biggest class codes automatically for under 150,000. The move to do that to help on the brokerage throughput and the submission throughput, the move to really focus on claims and put most of our attention on software management of claims. That's probably the other biggest inflection point we faced, 6 to 12 months into doing the MGU that has really guided the go-to-market strategy.
And as a company that started in its roots as a device, developer and manufacturer and tech driven to, where the business is today, did that sort of require a cultural shift in the organization? Did you have to, change the way you led the organization, message things, type of people you hired into the organization?
We definitely had to hire a lot of insurance talent into the business. When we moved from being really just a pure hardware / a little bit of software business that sold a value prop to self-insured, so we weren't selling the policy. We were a lot more, could center in on loss runs, the data around these types of injuries, but then really focus on the device. As we shifted to the MGU, it was really necessary to bring on a much broader swath of senior leadership that had, we had delegated authority, so we needed to build out an underwriting team. We really wanted to focus on claims management and oversight, so we built out a full operations team with a claims director, an expert in services on comp for the last 30 years, to really kind of fill in the gaps. We have our own director of loss control. Sometimes those loss control initiatives have nothing to do with technology. They're simply, you should do a safety stand-up every day. And so that has been a big shift in talent. Culturally, I would say it hasn't been as large of a shift because, we really focus on innovation and we have since the beginning of the business. And that still tends to be, kind of this idea of getting better every day in this segment and tackling the problems with technology culturally has been the same. But the talent needed around the table to identify what needs to get better and the practical side of, well, you can't really do that. That might get you, I think, our favorite saying from the individual I mentioned who has 30 years of experience here is that'll get you in an orange jumpsuit. And so those changes, really needed a lot more than a pure software or technologist input. That was critical to, changing in the business.
And did you have investors or other stakeholders that you had to convince that the move to the MGU made sense?
Oh, yeah. Yeah. You might imagine Kinetic is a typical venture-backed business. And when we raised money, early on, 10, 12 years ago, it was all around this idea that devices were going to change the world. And, everybody was going to be wearing a wearable device in 10 years. Well, look around, not everybody's wearing a wearable device.
Right.
And so, in 2020, when we said, hey, we think actually what you originally invested in is not going to, be a great return on your capital. And we think the right change is to really move into this MGU and insurance space. Oh, there was a huge amount of hesitation. That was immense talks of what does that look like? And, these were also investors that came more from a pure technology standpoint. So there was a lot of explaining of what do these structures look like? How are they successful? And that's continued, to be honest. We were fortunate. We did one other investing round right around that change where we brought on a lead investor who had a lot of insurance background. So Manchester Story is a group out of Iowa that does a lot of insurance-based investing. And so they had a really good feel for it. And that was nice to bring them onto the board and have that foundation. We also brought a couple independent board members on through the years that came purely from insurance and Insurtech. And that has helped, quite a bit, but it was a huge education, continues to be, and was a big shift. Now, I think, in our first year when we wrote, we went from 0 to 25 million in premium. Everybody within 12 months was like, hey, there's probably something here. But I can tell you when it was 0, it was like, okay, let's take a flyer on what's going to happen here.
Right. So when you joined the company as COO, I think it was it under the expectation that you would become CEO, or how did that transition happen?
No, it was still fleshed out. Or it wasn't fleshed out yet. I joined the company as CEO because I had a really good relationship of knowing the two co-founders, Aditya and Haitham, back from my time in New York, starting my first company. And they, had they had a very good grasp of the product and technical needs of the business, but the go-to-market strategy didn't have a lot of oversight. And so I joined, in a part-time consulting role of, hey, let's, they had a lot of data that showed the product was working, but it was, how do you package that data? How do you show it to customers? How do you manage, the go-to-market, the sales and marketing team in a repetitive way to really see if there's something here to push on, or do we need to make changes because, this market is not as big as we thought.
Got it. And so as you took over as CEO, how did you manage that transition, from a founder-led business to kind of outside management?
I think one thing that really helped was the very strong relationship that existed before I came into the business. So when I came into the business, there was already a very high level of trust between the two co-founders and myself, and the ability to start stepping into company-facing presentations and meetings, talking to the business of what I was owning. So as those transitions were occurring, kind of from consulting to full-time COO to CEO, there was already a lot of exposure to the company. But that transition, without a doubt, we tried to handle as best as possible, but there's always challenges as, management structures are changing and who's reporting to who. And, people, well, I've been reporting to the founder, I want to stay reporting to the founder, and how to handle those transitions. But I think the key was, you first have to have just an extremely high level of trust going on between the founders and myself. So that is transmitted and communicated down as this transition is happening.
And did you have prior experiences that helped you navigate this?
Yeah, I had my first company in New York was a logistics software business, and we sold that to a public company back in 2018, end of 2018. And I came into that public company. It was a fairly large business. It was 15,000 people. It was really the merging. They had just merged with another company about equal size, so they were combined about 200 million in revenue. They had two very big management teams. And I came in originally kind of just working with the parent business, but then moved to COO and CEO of the publicly traded company. So I had a lot of lessons learned from that experience of, you got to be careful about coming into this, bull in a china shop, and, which I had done in my first company, or this, the one that had bought us, and, how to establish that trust, how to make sure, I remember that company that bought us. I showed up one day in my role, and they didn't even know I had been hired. and so I'm, hey, I'm your new boss. And, that was just the most jarring thing in the world. So we were much more careful in communicating these, slow playing some of these transitions where it might be a little bit more precarious with the relationship that was in place. But I brought a lot of people from that business that had been through that transition at the previous company into Kinetic, that they're still here today. And they helped a lot with that.
And did you just sort of figure this out by trial and error, or did you have people who were influential in helping shape you as a leader?
Definitely had people that were influential. My first company, a lot of our early customers were really successful entrepreneurs. We did logistics software primarily for the restaurant ecosystem, and we sold that to a food delivery platform that is very similar to DoorDash or Uber Eats. And meeting a lot of those people that own these large restaurant chains and had built those, that was a really good input. Restaurant operations, I don't know how much you've looked at that stuff, but it's a nightmare. If you want to become the best people manager in the world, go run a restaurant. It's all walks of life coming into work at a restaurant, especially a large scaled restaurant group. And those individuals, trained me a lot on just the brass tacks of how do you manage and interact with people. And I think that, provided a lot of mentorship going into the additional roles. And then we've been really fortunate, a lot of these venture capital firms have started to pick up on the challenges that these growing businesses and people that don't necessarily come from the industries, which is a lot of what they fund, new ideas sometimes come from the outside. Then these people end up scaling these businesses, and these venture capitalists have seen the need to provide coaching and training to these entrepreneurs and CEOs. And Kinetic and my previous companies have had access to a lot of these coaching organizations that we've utilized, and those have been phenomenal in terms of providing basics and structures and kind of best practices.
So in terms of future product roadmap or additional growth of Kinetic, excuse me.
Don't worry, everybody calls it Kinetics, so don't feel bad. But Kinetic is the correct terminology.
Well, I'm in Connecticut, so maybe that's why I'm used to saying Connecticut instead of Kinetic. But anyway, no. But in terms of going forward, anything in particular you can share that you're particularly excited about, in terms of future iterations of the business or focus areas for the business?
Yeah, by far, the opportunity to manage claims better with software is immense. And we are just releasing this quarter a completely, so as you might imagine, we started as a device business. So a lot of the software that our customers or brokers would interact with was all relative to the device. How much are you using the device? What's the device data showing you? But through the last several years, as we've added really claims management as a key component of our differentiation and value, we now have gotten to a point where we have an overall dashboard for our customers and brokers to interact with that is really impressive. It gives you updated loss ratios on your policies. It gives you real-time claims resolution and reserving strategies, that you can get instantaneously as opposed to waiting for an annual review. And then the most interesting part of the platform is that because we're pulling all these notes in, we're not doing anything, I would say, novel in terms of how to manage a claim. We're just managing every claim as if a single, very experienced adjuster were working that file. Instead of what really happens, is that you've got a whole swath of experiences on the other end, from brand new to senior adjuster, and you've got them handling hundreds of files at the same time. Our software allows us to really focus in on, what would a senior adjuster do right now if they were just managing this file? And we identify these actions as next best actions. Like, this is the next best thing, we could do with the policyholder. And we've rolled out kind of the first swath of those next best actions into this platform. And they're really interesting. I mean, they're all the way from, there's an upcoming office visit for this employee. Let's make sure this employer is aware of this, that they're not scheduling this employee, that they're checking in a day before, that the employee is going to go to this office visit. So we don't wait 30 days for an MMI or some other, sort of development associated with a typical delay. And what's happening, and kind of the exciting part for Kinetic moving forward, is the continuous build out of those next best actions and the continuous addition of what else can we see in the data? What else would a senior adjuster do here to really have a perfect resolution, on this? And how can we provide that transparency to the brokers and the policyholders so they feel comfortable knowing this is handled as best as possible?
So is that sort of predictive analytics? Is that AI? Everyone's talking about AI these days. So how would you kind of classify that?
I'd say it's a mix of both, to be honest. There's some predictive stuff where we can tap data sources like ODG guidelines and compare them with the IDC codes, and then look at reserving practices and resolution strategies to see if they line up. There's really not a lot of AI in that. It's just data feeds and some predictive analytics. The main place we've been using AI is when adjuster notes come down into our system. It's a lot of free form entry. And it would be impossible to read, the thousands of manual entries across these claims and identify and distill down to what can be communicated to a broker or policyholder in a very simple language format, or to us, of what's going on, without, a team of hundreds of people. And that's really where I'd say AI has made the best impact for us, is we can look at those free form notes from an adjuster and then distill that down into actionable insight. So it's a mix of the two, but I would say AI is pretty limited to how do we take all this data that is messy and would just take an army of people to really look at and be trained at how to identify these patterns or what's in these notes, and do that in half a second with the LLMs that are out there.
And do you think that you will invest in AI in new ways, or will it just be trying to get those LLMs to be kind of more and more effective at navigating?
We use off the shelf. I mean, we don't develop our own LLMs, and I think we're seeing that each new model is more and more effective. The place that we do invest in AI is bringing in software developers that can then set up AI agents that can act on those notes. That helps a lot in terms of these automated actions. Instead of us notifying the policyholder, with an operations person, hey, you've got this upcoming doctor's visit, we can have an AI do that outreach in a more compassionate and kind of personal manner than just an automated message that might go out that wouldn't use AI.
So I know we're getting close on time here. I don't know if you have an extra minute, but I personally have a belief that sort of the future org chart is going to be a combination of humans and agents, and that you need to have people who are going to be comfortable working with agents and potentially managing agents. And that's where companies can get some real leverage at really all levels of the organization, potentially. And I'm just curious, is sort of what you described there, is that sort of something philosophically you would agree with, or is this just like a tactical efficiency approach that you guys have landed on?
I would 100% agree philosophically. I would say it's not even philosophical, it is happening. So we have agents already that we put names on and, reach out to adjusters to gather information on work restrictions or follow up on certain types of information maybe that's not coming through our system. And we actually had to tell Nationwide Mutual, like, hey, they were treating our agents like people. So, these agents were saying like, oh, thanks so much for sending me that data. And they thought we had hired 4 or 5 additional employees to do this. And we had to actually confirm with them, like, no, these are actual agents that are, looking like people, but, are managing, the intake and outtake of this data transfer. So, and we have a team that oversees that from a product perspective. And so I'd say it's already happening. It's not even the future. Like that's what advanced groups are doing at this point.
And in terms of the, third-party AI regulation and some of the other things that NAIC are looking at and things like that, like how is Nationwide to deal with this? How are you approaching that from a, regulatory point of view and making sure you're kind of not creating exposure?
Yeah, the main thing we do is we don't take sensitive information out of there. We never have them transfer any sensitive personal or medical information. So we stick to just basic details about pricing and publicly available adjuster notes, which they always kind of do a brick wall between more of the sensitive medical information and personal details. And so we're very clear to make sure we're not transferring anything that could be exposed, or even though we have a lot of security around how we're housing this information, and we're doing it in an own paid instance, so we don't, it's not publicly available and back into the masses like some of those therapy sessions I think that we saw that became public. Yeah, we have all those securities, but on top of that, we very much verify that nothing is coming through there that would trigger anything sensitive.
Got it. All right, great. Adam, is there anything else you'd like to share before we wrap up?
No, I mean, I think we're excited. I would just say, if there's an agency out there that wants to be a true risk consultant and bring unique products to workers' comp and has a book that focuses in our industries and would like to partner with us, feel free to reach out to us. But we're excited to keep on growing in these areas and bringing this development and technology to the masses.
All right, great. Well, Adam Price,